Hello everybody, I am Pravesh Agi. Welcome to my channel. I am a chartered accountant currently working as a visiting faculty with the Institute of Chartered Accountants of India and associated with many universities in India.
So now let's understand about the business fundamentals. Now, whenever we analyze a balance sheet, the income statement, the cash flow statement, and the management strategy, so this will all help us to determine the company's health and its future prospects. This is termed as company's fundamentals. A company who's having an increasing market share, a good profit margin, growing bottom line, very less debt, and has a lot of free reserves is considered to have strong fundamentals. Now we can do a company analysis. There are two kinds of analysis. One is called the quantitative analysis, another is called the qualitative analysis. So let's understand what is quantitative analysis. So the investment professionals, they look generally at the assets, liabilities, revenue, and expenses and other financial metrics of a company whenever they do a quantitative analysis. So what they look at is the price earning ratio. That means what is the relationship between the price and earnings. So we'll understand this more deeper as we go along. The book value of the company, the earning per share, is the EPS growing? The market share, what is the trend of the market share? Growth track record of the company. So these are the very, very important quantitative metrics which a prospective investor or an investment professional will always try to look into. Now the other analysis is the qualitative analysis. So these are the aspects of the company that are not quantifiable or cannot be explained easily by numbers. They are called soft metrics, such as the business model of the company, the quality of management, what is the track record of the management, what kind of business model the company has adopted to make itself profitable, the corporate governance track record, how well the company is utilizing its resources, and how they are rewarding their shareholders and all their stakeholders, the competitive advantage it enjoys compared to the other competitors in the industry, and how well are the customers satisfied from the products and the after sales services of their product. So gathering all the above data can provide a better idea of how a company intends to grow its business while they reward their shareholders. So this is called the qualitative analysis. So there, again, to sum up, there are two kinds of analysis: quantitative and qualitative. Now, quantitative would generally mean the profitability of the company, the earning per share, the PE multiple, that is the price earning ratio, and the qualitative analysis would generally mean the quality of management, the track record of the management, the track record of the corporate governance of the company, the advantage they have in the competition compared to the other players in the market, and how well satisfied are the customers. So we are going to understand how do we do financial analysis. Now, financial analysis is very helpful in understanding more about the business fundamentals. Now, one of the very important tool is called the ratio analysis. Now, through ratio analysis, we can understand the financial health of the company, how solvent is the company, what is the profitability of the company, and what is the growth trajectory of the business. Now, there are four kinds of financial ratios we'll understand going forward. Now, there are four kinds of financial ratios, the first being the valuation ratios. How do we value a company? How do we compare the current market price of the share with the fair value of the share? That means whether the share price which is prevailing in the market represents the true intrinsic value of the company. If the company's shares are overpriced, then we'll not buy them. If the share prices are undervalued, then we'll go and take an investment decision to buy the shares of the company. So here, basically through valuation is a very, very important metrics which helps us to take decision with regard to whether we should go and buy the share or the security at the present from the market, whether we should buy the shares or the bonds in the market at the current value. If they represent the fair value, then it's good enough, we should buy it. If they're undervalued, then also we should buy them, because then we'll make profits as we go along. But if they're overvalued, then we will be rather taking decision only when the share prices reach to their fair value. Then we come to the liquidity ratios. Basically, this helps us to understand whether the company is able to meet its financial obligations, both short-term as well as long-term. Whether the company is able to pay its suppliers in time, whether the company is able to pay its operating expenses without much difficulty, whether it is able to pay its loans, installments to the banks. So the liquidity ratio basically understand how liquid is the company, so that they don't have any working capital or working capital issues. Then we talk about the profitability of the company, the operating margin. How well healthy is the operating margin compared to the operating margin of the other companies in the industry? Whether the operating margin is going up or going down. So we'll understand all this in profitability ratios. Then we come to leverage ratios. Now, there are two kinds of leverage ratios. One is called the financial leverage, another is called the operating leverage. The financial leverage is basically, the financial leverage represents the capital structure of the company. How much is the equity and how much is the debt in the capital structure? If there is more debt, then we say that the company is leveraged. And the other leverage is called the operating leverage. Basically, it is a relationship between the total fixed cost company incurs compared to its total cost, which it actually incurs while doing business. So it is the fixed cost versus the variable cost. So if the company has more fixed cost compared to the variable cost, then we say the company is highly leveraged. Because any amount of more revenue or sales will bring more profits if the company is highly leveraged. But it can turn vice versa. If the company's sales shrink or the market, if the sales go down, then the company suffers more loss. So leverage has its own advantages and disadvantages. And going forward, we'll understand about all these ratios more in detail through examples.
Hope you all enjoyed the lecture as much as I did presenting for you. Do add your comments, as it is very encouraging and motivating. Please do like and do subscribe. Thank you.